Hey, everybody, it's tax season. Tax season 2013. Tax laws 2014 is when it's actually open. So welcome to the beginning of tax season, and we're going to give you the best tax help ever. And if you have any questions ever, you can just call us, and we're happy to help you because that's what we're all about. We want to help you not overpay your taxes and to do it right. And join the studio, I got Christopher Fabian here. Hey, Chris.
Hello, Esther.
And Tiffany Fabian.
Hey there, Esther. How you doing?
I'm good. And Stevie Jacobson.
Hey, Esther. How's it going?
Good. And Happy New Year to our listening audience. We had such a wonderful 2013. We're looking for a wonderful 2014. We love helping you, and that's what this show is all about. Our phone number here in studio is 803-0930, 803-0930. Star 930 on a cell phone. We want to hear what you have to say. I know somebody just emailed me a couple minutes ago, and she said thank you for putting the broadcast back on the website. She was happy about that because she works on a Saturday afternoon and misses our program. So it was off, but it's back on. We have Steve to thank for that. And again, we're going to talk about the tax changes because this will affect the tax return that you're filing right now. So the first one is the American Taxpayer Relief Plan. It's interesting how they use that language to make it sound like it's better than it is. But so the American Taxpayer Relief Plan was implemented starting January the 1st of this year. And the first one is that marginal tax rates got added to the top rate. So what does that mean, guys?
Sure. Instead of the highest threshold being 35%, now it bumps up to 39.6. So perhaps if you were at the 35, you could eke up to a little bit higher of a tax rate. And so you want to keep that in the forefront if that's
right.
a situation
so
for you.
If you're a wealthy individual, you're going to pay an extra 4.6% for sure, plus some of the other things that got changed too. And that brings us to the second thing, is there is a new top rate for cap gains.
That's right, 20% for top rate capital gains for those higher income earners as well. So they're going after kind of what, everybody was going after Mitt Romney for during the election, where they were saying, oh, well, Mitt Romney's secretary pays more. Well, part of that was actually because of the fact that Mitt Romney had investments.
Right.
That's right. And so that brings us to the third thing, is that they retain the 0 to 15% cap gain rate on people whose income is under $200,000 if they're single and $250,000 married joint, correct?
That's right, which is really nice. So that is relief.
Right, but explain that to people because it doesn't really mean that you don't pay 0%, right? I mean, it is 0% on the capital gains, but it kind of affects your other income.
Right. So if you have, we'll say, $50,000 worth of wages and you are in the 15% bracket and you sell enough stock with capital gains to keep you in that 15% bracket, those capital gains gets taxed at 0, but the other income could potentially get taxed at a higher rate. Where, we'll say with the Social Security people who are seniors aren't used to paying taxes, possibly, where now if they sell their stocks because there's no capital gains, well, it could impact their taxable Social Security, which would make them pay taxes.
That's right. And what people don't understand is, if you are somebody on Social Security and you haven't had to pay on your Social Security because it didn't exceed $25,000 or $32,000 with half of your Social Security getting added into because your income was low, if your broker, because this was a good year for stocks, 2013, if your broker had sold a lot of stocks and you have a lot of capital gains, it's true you're not going to pay any taxes on the stock, but it may make your Social Security 85% taxable. So you won on the left hand, but on the right hand, it can still hurt. And then, of course, on New York State, do they cut anybody any kind of a break for cap gains?
Definitely no.
Right.
And And then another thing, just switching back to number one, the first thing we talked about the tax rates going up. I think a really important thing when I'm sitting down with clients, they're like, oh my God, if I make a little bit more and I switch into that other tax rate, all of my income becomes taxable at that other rate, which is not the case. It's just the amount of income that slides into that higher tax rate is taxed at that higher rate. So you want to pay attention to that, because I think Chris points out a good example is you don't want to forego
making $10,000 to pay an extra $400 in taxes.
Right.
Now, so because what happens, because it's graduated, you pay 10% on the first level, 15% on the next level. That doesn't mean that everything is taxed at the next level. It means that once you get to that next tax bracket, you only pay 5% more on the next level than you did at the last level. So when people say, oh my God, I don't want to get into the higher tax bracket, the tax bracket might affect your tax liability by 5% on that income. And if it's $10,000, it's $500.
So don't necessarily
you would never say, I don't want to make $10,000 because I have to pay $500 more in taxes than I would have if I was in the old bracket. So that's what's very important when you're tax planning, right?
That's right. So you make sure you sit down with somebody and you ask the right questions, and we'll provide the answers.
Right. 803-0930, 803-0930, star 930 on the cell phone. I'm Esther Goulias, the tax lady from EG Tax. All of our offices open up officially on the 20th, correct?
That's supervisors go in on the 17th, which is
on the 17th,
on Friday.
That's what I know.
Yeah, on Friday. They're staffed with all the other individuals, all our regulars.
So much with the IRS this year. We switched the dates a few times.
Right, but we're open even though the IRS isn't. That's the most important thing to remember.
Right. So the IRS is delaying the first day of electronic filing till January the 31st. But we have, even though the IRS doesn't have all their stuff together, we have all of our software, and we're ready to go. So the important thing is, if you got your W-2s and you want to file, we can get you sent in, and it's waiting. So the first opening day, boom, you're good,
I think
ready to go.
Steve did a tax return yesterday, right?
I did.
Yeah.
My first 2013 return for somebody.
And it went well.
Steve is no longer a virgin this year.
For 2013.
He's in the bag.
Okay, another change. And I know we have people holding, but let's go into the other change from the American Taxpayer Relief Plan, the 3.8 net investment income tax on top of people that have investments, correct?
That's right, and this is a tax on top of your tax. It's a surtax, like a sales tax on your investments. If you make over $250,000 if you're married, $250,000 if you're married, $200,000 if you're single, you will pay this 3.8% surcharge on interest, dividends, net capital gains, net profits from rental, real estates, and royalties. So all those things can be affected by it.
Okay, and then the next thing is, obviously, we've been talking about this for months, is the health care reform implementation. It is in effect starting 2014. And so if you come to see us in April and you haven't signed up for Obamacare yet, you can be penalized, correct?
That's right. $95 the first year for certain filers, up to 1% of your income. And then it goes up each year beyond that.
Right. So it's 95 up to 3 people in your house, so it can be up to $285 the first year if you're married with the another adult in your house. It's half of the $95 if you have a child in your house for that child. But, you got to look at weighing the costs. Should I get insurance or should I not? It still might be cheaper the first year to go without insurance.
Okay, and provided you don't get sick.
Right.
It's providing you don't. Well, that's always, yeah.
And I know, but that's really because you're playing kind of Russian roulette,
that's right.
where you say, I don't want insurance. But here's one of the wonderful things is you can actually go to our website, and we have from, it's New York State of Health. It's a link on our website, and you can actually see how much your health insurance is going to cost you, so you can make that determination whether you want to bite the bullet and pray to God you don't get into a car accident or have any problems, or whether you want to get the health insurance, and and that's right there. So the knowledge is power, right? I'm Esther Gullius, the tax lady. Join us on the other side. We're going to take a short break. I know we got your phone calls waiting. We're going to finish some of the tax law changes, and then we're going to talk about getting ready for tax season, and we want to help you. 8030930, 8030930, star 930 on a cell phone. See you on the other side. Esther Gullius, the tax lady from EG Tax, and it's tax season, and we're going to help you get through this year. It probably will be a lot like last year, people. It used to be that we could tell you the day you're going to get your refund. Now we don't know because the IRS doesn't let us know. And if we knew, we would tell you. But we will help you to make tax season as smooth as possible, and that's what we're here for. I have Steve Jacobson here, Christopher Fabian, Tiffany Fabian, and myself, and we want to help you. And I know we have a bunch of calls waiting, and when you hear them hang up, 8030930 is your cue to call in, star 930 on a cell phone. Want to talk about some of the other changes in the, obviously, the standard deduction went up, personal exemptions went up, the mileage rate went up, but these are major things that are happening here that we want to talk about. Tax treatment for same-sex couples, which is especially important in New York State, right, guys?
Right. Well, New York State, people with same-sex marriages would able to file how they normally would on the federal, but on New York State, they had to change it. They had to either file married filing joint or married filing separate. So you have a totally different return than the federal. Well, now the federal government came in and said, well, if you got married in a state where it's legal, we're going to recognize it. So now on the federal return, you either have to file married filing joint or married filing separate. There's no more single or head of household status for same-sex couples.
And so what's so interesting is I know that a lot of people that really push for this thought it was going to be so good, but the thing is there is a marriage penalty embedded into the tax law. For instance, like the tax rates increase if it's $250 married joint, $200 if you were single. So if you had a couple living together, they could have made $400,000 before they got to that top rate. Now it's $250, and so many same-sex couples are going to find out that because they got married, they're going to pay a lot more in taxes.
That's right. That's exactly right.
Being single would have saved you money in your tax return. But so there's no option now. It's either married joint or married separate, and you can't be single unless you get a divorce. So that's one of the changes. And of course, you actually can go back and amend the last couple years if you had filed singly on the federal, and you can go back and file a joint return. Is that correct?
That's right. That's right. And you'd want to run the numbers.
If you had been married in New York State before then.
Right,
correct?
And see if it would be beneficial and behoove you to do that.
Right. And then the tangible property regulations, when you're setting up assets that you bought during the year, that's finally been handed down by the IRS, so we know what needs to be depreciated, what can be expensed. Expiring provisions, there's a lot of expiring provisions. In 2013, last year, for tuition and fees deduction, educator, energy, and sales taxes, right? So this is our swan song for those write-offs. In 2014 going forward, those are not going to be in there anymore.
And correct? I could tell you the energy and the sales tax are two big ones that we see all the time in our office. The seniors with the sales tax, and then the energy improvements. People are doing those like crazy. And granted, it was only a $500 lifetime credit, but still for new homeowners, it was a big incentive.
And of course, that's going by the board. And that's until Congress gets a hold of it again. We never know what they're going to do in the middle of the year. We keep you posted. Tax season is delayed. We just told everybody it's not till January 31st that you can actually file your return electronically, but we can get everything ready to go. So we have your signatures, we're ready to go, and the minute the IRS is open, boom, we'll have that return on their doorstep on the 31st. And then finally, the office and homes, it has a new standard deduction, correct?
That's right. Instead of running the numbers and actually applying the math and doing it, you can take the standard deduction for
Right.
that.
I got to try that just to see if it would work out better for the customer. I mean, he had all his figures, but with that Schedule C I got
aren't
to do
aware
for
of it.
2013,
Right.
it basically says, what's the square footage of the office? What's the square footage of the home? Okay, here's $1,000 we're going to give you towards the deduction. It was pretty neat.
That's cool.
I believe it's, I want to say it's either $30. It's a maximum of a $1,500 credit, so it's
Right.
either $50 a square foot or $30 a square foot. And I can't. Sorry, just right now the math.
But what's so cool is many times people said to me, "Oh, I'm so afraid to take an office
Right,
in home," and they're working out of their home in a room
that's
used
solely and
regularly
exclusively
for business, and they didn't want to take it. Well, now the IRS has made it really simple to do that, and that's one of the big changes for this year. All right, I'm Esther Golias, the tax lady from EG Tax, 8030930, star 930 on the cell phone. We're going to go to Ricardo. I love that name. Ricardo from Dupuis. Hey, Ricardo, how can we help you?
Good morning, Esther. I have a problem. I had an IRA rollover, and I didn't realize that I turned 70 and a half in March. I mean, I'm born in March, so I guess in September I became 70 and a half, and I failed to take any deduction in 2013. Is there any way I can make up for that in 2014 by taking a little more or something like that?
We got good news
the year
for
you turn,
Ricardo.
Yep.
Somebody tell Ricardo.
The year you turn 70 and a half, you can forego that year and take it in April up until
By April 1st.
April 1st of the following year. You'd have to take both RMDs by that period, but
No, you take the first one by April.
April.
And by December 31st, you can take the second
one. So you're in good shape, Ricardo.
Oh, by April. And then what is it? I have to divide there's 70,000 in this rollover. How roughly what would I have to take out both for the April one and no later than December?
The first one you would have to divide by 27.4. Okay.
Oh.
And then it goes to like 26.8. So if you said 70,000,
So it's like $2,500 twice next year. That's right around there. So,
Yeah.
so that's all you have to do is do your first RMD by April the 1st and the second RMD by December 31st, and you'll have no penalty.
Oh, thank you very much.
You're very welcome.
Happy New Year, Ricardo.
And let's see, we have Dave in Depew who's been patiently waiting.
Okay, Esther, I heard something. I qualified for Obamacare, Medicaid. Okay. What I heard is I'm 53, and what I heard is if you get the Medicare after 55, that whatever that cost is to you, I'm not at that point yet. Whatever cost you incur will probably be like Medicaid now, like if you're elderly, and it'll take that money and put a lien against your property or things you own later on.
Not at all.
True?
No.
Guy, explain it to him.
No, what you're talking about, Dave, is getting Medicaid, which is Medicaid managed care. It's basically health insurance under the Medicaid program, but you can actually go with a provider like Independent Health, Blue Cross Blue Shield, et cetera, et cetera. And as of right now, with the way the law is written, that is fully government funded. You do not ever have to pay that back.
Okay, so if I qualify for Medicaid now, in a couple years, if I'm 55, then that won't be I know because people are going to nursing homes and they acquire their assets and that.
Right?
So
No,
it's not
that's a different kind of Medicaid. You're thinking of two apples and oranges in this case. This is Medicaid managed care, which is strictly health insurance, not the same Medicaid that deals with the nursing home.
See, because everybody is, you have to understand, the major tax law change and health insurance changed January the 1st. So the way it was is no longer the way it is. So one of the major changes is for health care, and if you're somebody that has income that's at the poverty level, you're going to find out that your health insurance is completely provided by the other taxpayers in the United States for you. So, and it's not going to be a lien on your assets.
Okay, thank you.
You're very welcome. I'm It's the tax lady, 8030930, 8030930. Star 930 on cell phone. Love to hear what you have to say. We're from EG Tax. We certainly want to help you. And we have David from Marilla hanging on the phone. Hey,
hello.
David.
Hello?
Hi.
David, can you hear us?
Hello.
Hi.
Hey, what's your question?
Hello?
I'm going to put David on hold. And
we're going to go to Mike. Why
Yep.
don't we do Mike in Buffalo? Hey, Mike, how can we help you?
Hello, Esther.
Hey.
I'd like your thoughts on this. I'm 57. I'm looking at retiring maybe around 62, 63, and I have money in IRAs, and I'm thinking of converting some of that to the Roth, pay the tax now over the next several years so the money can grow tax-free in the Roth. What's the tax implications on my Social Security?
Okay, so let's back up here. Do you have another pension plan provided for you besides the one that you're talking about right now?
No.
Does your wife?
So this is your one and only pension plan, right?
Yes. That's
So
Social
how much
Security.
do you have in there, or what do you think you'll have in there if you just keep it in a traditional at age 62?
In the Roth right now, there's probably 130, and in the regular IRA, probably about 470.
470,000?
Yes.
Is that correct? All right. So that right now, let's say that combining the two would put you at 600,000, right?
Yes.
If you were getting a 3% return, that would be $18,000 a year. Are you a married gentleman?
No.
Okay, so $18,000 a year. All right. So with your standard deduction and personal exemption, you're going to pay about $400 in taxes if you didn't roll over, if you just took it out as a traditional IRA, okay, on $18,000, because after your standard deduction, personal exemptions, you're going to pay $400 to $700 a year in income taxes. But your $470,000, if you roll it over, you're going to pay.
Well, how much are you making right now?
You're going to pay about $116,000 up front to convert it.
Well, I wouldn't do it all at one time. I would spread it out over a number of years.
Right. Well,
I'm using 25%. You're still going to pay $116,000.
I mean, what is your income right now, Mike?
Probably about 50.
Okay.
Yes.
So let's say $100,000. Let's knock it down. So you're going to pay $100,000 up front, but you're going to pay about $700 in taxes if you take it out over without moving it over. All right? So that means it's going to take about 15 years that you'd have to pay taxes in order to equal what you'd pay, boom, if you just rolled it over to a Roth. So what you have to do is put a pencil to the problem and see how it all works out.
We got to take a hard break right now for the news.
Oh, we do. I'll see you on the other side.
Okay.
Hey, I'm Esther Goliath, the tax lady who got. I was just so engrossed in Mike's question, I almost didn't break for the news. Oh my God! But anyway, so here we go, Mike. So here we got $470,000. I was right. It was because you got a state of New York, which is going to be fully taxable too. So it's about $120,000 you'd pay in taxes up front, so that it won't be taxable later. So here's the deal: you would pay $700 extra in taxes. So that's like 15 years before you break even if you roll over that money into a Roth now. Now, if you know you got a windfall, if you're somebody that's got a state of New York pension, you got a bunch of money that you're going to get later on in life, when you're doing your planning, you may say it's worth it to pay the $116,000 up front. But for many people, number one, here's the thing. Number one, it would take 15 years to break out even. Number two, do you know what the tax rates are going to be in 15 years? Do you know that there's going to be an income tax? Maybe they're going to revert to a sales tax, and so the money is put up front may never happen. Number three, will you be alive in 15 years? Right? So these are things you have to.
How about number four? Is the market going to stay strong, or is it going to crash? And then you'd pay tax on money you never got.
That's true. So, I mean, those are all things you got to look at. I would think that maybe if you are concerned about the Roth, and I don't think that you really need to be, but if you were, then I'd put fresh money in the Roth, but I would never pay the money up front. That's just my opinion.
Okay, not pay
Okay,
it.
Mike? But if you want us to show you it in black and white, we'd like to. It sounds so, it almost sounds sexy to think, oh, my God, I'll never have to pay taxes. No, you're going to pay it up front,
Right.
So you got to really understand all the ramifications and what you're really saving, because the standard deduction and personal exemptions are pretty high. They're moving forward, and they're looking at big tax reform here in the next couple of years. Gosh knows what they're going to do,
And I like your logic about putting fresh money in it. That's a really good idea.
Yeah, and so then it's a win-win.
Right.
Yep. Yes.
Thank you. Here. I'm Esther Golias, the tax lady, 803-0930, 803-0930, star 930 on cell phone. Love to hear what you have to say. I think we have Don holding, right?
Hi, Don. How can we help you?
We do.
Hi. I have a question. I have a bunch of sleep apnea, medical, and it's for work, and I'm wondering, do I take it as a work expense or as a medical expense, or how do I...
How is it for work?
Okay, well, first of all, that's another change that happened this year, is that the medical expense deduction for people under the age of 65 has now gone up so that the floor is 10% of your adjusted gross income. Sleep apnea sleep apnea
Equipment.
unless you're a sleep therapist, was not going to be a medical. It's not going to be a business
expense
deduction, but would be a medical deduction. So it'd have to exceed 10% of your adjusted gross income.
If it's like I don't work unless I have it. I had to, even though I was mild, I had to have it, or I couldn't work driving, and it was just all the expense with it.
Right,
I understand, but that is a medical expense. The only way it could be a business expense is if you were in the business of doing sleep apnea studies where you're, that would be part of your expense for being an employee.
And you bought the machine for somebody else to use so you could study them.
That's right. But this is a medical expense for you, and how much is your income, Don, per year approximately?
70.
So it has to exceed
So
$7,000.
your sleep apnea and other medical expenses paid out of pocket have to exceed $7,000 to get a dollar deduction.
Oh, okay.
Okay?
Okay. Thank you.
Thanks for calling. Happy New Year. I'm Esther Golias, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. And I think we have Paul from Cheektowaga holding, right?
We do.
Hey.
I just had a question about the Obamacare insurance. I tried going on your website, and I couldn't find the calculator. It's probably my fault.
It is there. Yep, there at the on the main page of the screen there, Paul. There's a little picture slideshow, and one of the pictures says "Your Guide Through the Healthcare Maze," and that's where you're going to find it right there.
Right. Actually, I'm right on the website right now. It's the question: how much will it cost to buy insurance through New York State Exchange? Then Then there's an underlined thing. Click here to download the worksheet. Now you got to have
Microsoft Excel.
Yeah, you have to have an Excel. It's got to be able to accept Excel because that's the spreadsheet. But it's right there. If you need any help, you can call us at the office. We'll help you. But go on. What can I help you with?
Okay, well, I also tried through the New York State website just to kind of shop around, see what it is. I'm 27 years old. I'm pretty healthy. My plan is just to kind of pay the fine. But I was kind of shopping around just out of curiosity, like what you can't even shop unless you sign up through the website just for an account. And the New York State website, I couldn't sign up to either. I heard you help people on the show before. I didn't know if I called you, told you my age.
Hey, I'm going to help you right now. So let's do this. How much is your income?
About 40.
About 40,000. And you do have any tax-free income? Like
I have a Roth
Security.
IRA.
Pardon me?
No, I have a Roth IRA, but that's not really income. It's more tax-free earnings. Right.
All right. Now I'm going to give you the price for a bronze. What county are you in?
Erie County.
Okay.
And Paul, are you married or single?
I'm single, no kids.
Okay.
Okay. So, let's see, we got just one person, right?
Yep.
Okay, so we got one. Okay. All right, so here we go. The lowest premium per month for Health Republic, which is freelancers, for bronze is $218.28 a month. The most expensive is $389.71 for independent health.
And what would the deductible be? Does it say or no?
Oh, well, that's bronze, so the deductible's pretty high.
Like 5,000?
Right, guys? You guys know?
I think it's
5
and 10. No, that's catastrophic.
6 and 12.
No, it's
4 and 8. 4,000. It's 4 and 8. 4,000 for single, 8,000 for married joint.
Okay. Thank you very much.
You're welcome.
You're very welcome. I'm Esther Goulias, the tax lady. 8030930. 8030930. Star 930 on the cell phone. We're going to go right up to the break with getting ready for tax season. And I will tell you, with the IRS, the new stance that they've been taking, and you guys can correct me if you think I'm wrong, is that they're pretty much auditing the return before they send your refund back in many cases.
Right.
Yeah, the
application.
The IRS has become New York State.
Yep.
Where New York State used to do this for years, where instead of giving you the refund, they say, "Hi there, we don't know if you really have these expenses, so please send us the documentation and we'll release the refund."
Right. So to counterbalance that, you can change your W-4 at work so you don't get such a big refund, so that you're in control of your money up front. Otherwise, make sure that all the information that you're putting on your return is absolutely accurate.
And you know where to get that documentation.
If the IRS is getting a copy of the same form that you're asked to put on your return, and you're kind of taking a shot at it, like you know that you did self-employment income and it was around $4,000, but the 1099 form that you get says $10,005, the IRS will take the position that the $10,000 you reported is what you're saying, but there's an additional $10,005, and it can be very frustrating because you have to prove that what they have is different, is the same as what you put on your tax return. So accuracy is very important, especially for education, right?
I have a client who had the refund last year, and they had rental income, and the 1099 from the housing authority said $4,000, but then they got another 1099 from the housing authority which had money in the non-employee compensation, so they had to go to Buffalo Housing Authority and get another corrected 1099, but the IRS called them on it right away.
Right, and unfortunately, both the federal and the state, when they find a discrepancy, you're guilty till you prove yourself innocent.
That's how the tax law is written. It's up to you to prove that what you're putting on the return is correct. So you want to make sure that you understand what you're putting down, that you have proof for what you're putting down, because it could hold up your refund for 3, 4, 5 months if you're not doing it accurately. Now, the other thing is our offices are open on what day? Is it Thursday or Friday?
They open up on Friday.
The 17th, right?
Correct.
So our supervisors will be in office. Even though the IRS is not accepting returns till the 31st, we can get you all set, ready to go. We'll have the return done. We will have it at the IRS, so the minute they're opened up, boom, your return is in there and ready to go. Now, the other thing is that I thought was interesting to talk about, and again, if you want to talk to us, 803-0930, 803-0930, star 930 on the cell phone, is things that get you audited. One of the first things is that if you make too much money, you're more apt to get audited, correct?
Yep, I think that's true also, because if you make more money, you have more write-offs and more things on the Schedule A, but definitely that's true. There's more stock trades, more dividends, more interest.
Well, right now the stats are 1 out of 100 people get audited. As your income goes up, the rate of audit goes up to 3.7%. So it's like 370 times more now that wouldn't make you want to not make money, but that's just a fact. Number 2 is failing to report all of your taxable income. That'll get you audited.
Well, and that's such a rookie mistake, not to sound like, I mean, I guess that's the best way I could describe it, because what people don't understand is that when you get a W-2 or a 1099, so does the IRS, and all it does is it takes them about a year to have their computer system check over what they got versus what you got.
That's right. I'm Esther Golias, the tax lady. We're going to take a short break. Join us on the other side. Give us a call, 8030930, 8030930, star 930 on the cell phone. See you on the other side. I'm Esther Golias, the tax lady from EG Tax, and it's tax season, and we want to help you to make sure that you don't overpay your taxes. I got my bevy of experts here with me, Christopher Fabian, Tiffany Fabian, and Steve Jacobson, and we want to help you. So if you have any questions, 803-0930, 803-0930, star 930 on the cell phone, and we're talking about what gets you audited, taking large charitable contributions. That'll do it.
Yep. You've been on lots of audits for charity.
And they're going crazy over all that, especially the non-cash ones. If you're claiming a high amount of non-cash, and I think the big red flag for that, too, is if you have over $5,000 in non-cash donations, what must you have, Chris, in order to prove that?
You got to have an appraisal done.
Right. And nobody ever does.
No, because you don't think, well, if I give so many bags of clothes here and a little bit of furniture here, and that totals over 5,000. They could look for it, even though it's over. You got to have all your proof. Have the pictures. Have signed receipts. Have logs of everything you've given to prove.
And just for the record, there is no amount that is allowed as a charitable deduction.
I hear that every day.
I can't tell you how many of my clients say, just give me what they allow. Like they don't allow anything.
Yep.
You have to have a receipt, and that's the law, and you have to have proof of what you gave, because there is no standard deduction for charity.
There's no, I put $10 in the basket every week I go to church. And it's cash. You can't just put that down. You got to have proof you gave the $10.
Here's the envelope.
All right, and then another thing that gets you audited is claiming day trading losses on the Schedule C. Explain what a day trader is.
Well, a day trader is someone, actually you could almost call it a minute trader, because that's basically what they do. It's someone who buys and sells stock all day long. They're not a broker. It's themselves trying to make money really fast, and so they buy AAA stock right now, and then an hour later they sell it, and then they buy it, and then they sell it. If you lose money, that all goes on a Schedule D. That's not your business.
Well, but a day trader actually can take it on a Schedule C, but they'd have to prove that that's what they're doing. They're trying to make money off of short-term swings in the market, and they're not limited to $3,000 in capital losses. But I will tell you, those people, they get audited. Claiming rental losses, that's another thing that gets. Now, that doesn't mean that people should be afraid of the audit and not take the expense, right?
Right.
But we're just talking about things that get people audited, and another thing is claiming rental losses.
Absolutely.
Well, how about claiming expenses with no rent? That's a big one.
Yeah.
That's a huge one.
You can't just put a sign.
A rental property is supposed to be to make money, right? And so you have to rent the property out at fair rental value, and failure to do so will limit the deductions you can take, and you end up with claiming income, and in many cases you aren't even able to take the expenses if you can't itemize.
Yep, absolutely. If you're not doing it for fair rental market income, it has to go on line 21, and then the expenses up to the income are subject to 2% on the Schedule A. So you really have to be careful that you're in it for fair market rent.
Well, we got people holding here. We have Sandy from Pendleton. Hey, Sandy, how can we help you?
Hi, Esther. Thanks for taking my call. I actually have two questions now, because I just heard you talk about something that brought up another question.
Okay.
I donate clothing and, household items, that type of thing. Our church has a huge little house on the property, and they have receipts from the church that are printed up, and you take one of these receipts when you put your bags inside. Now, no one has signed that receipt, so that wouldn't actually be something for the IRS to verify?
Well, the first thing you'd have to do is the receipt is just available to anybody, so there's no date stamp on it. It doesn't say 2013.
That's correct. It's just a automated printed receipt.
Well, that would be a problem, because you have to prove that the donation was given in 2013 I would suggest you take pictures of the donation, and I know Steve always says that the person accepting the donation would sign off on it. And so that's really, in the event of an audit, you have to prove that it really happened in 2013, the value of the items, the names of the items, the cost, and fair market value at the time you gave it. And if it's over $250, you have to have a contemporaneous receipt if it's cash, and you have to do Form 8283 for donations over $500. So the more you have, the better it is.
Okay. This contribution, this clothing contribution, goes to a specific area where, when you take it to the Salvation Army, there is someone there actually to sign for it, but then it goes into a store for sale. I'd rather just donate it the other way, but
right. Well, I mean, if it's right on it where your church is, just go right into the office of the church and say, "Can someone please sign and date this receipt for me?"
That's great. That's a really good suggestion.
All right, that's a thought. Now, my second question was this. Thank goodness I don't have to deal with this Obamacare because I'm on Medicare. But I am trying to help my brother. And when you were talking about the deductible, these enormous deductibles, $5,000, how long does the person, I'm not sure I understand the deductible. Like, is it doctor visits? You have to add up $5,000 before the Obamacare kicks in?
Well, no. See, I mean, this is a high deductible medical insurance plan. So there's four kinds of medical insurance. There's bronze, silver, gold, and platinum. Mm-hmm. The bronze only pays 60% of the medical bills. Then there's silver, platinum, and silver, gold, and platinum. Platinum pays 90%. And it has basically no deductible. So when you go for the lower cost, monthly cost, the deductible is much higher. So it's not going to cost you much to have insurance, maybe $2,400 a year, but you're going to pay a lot more out of pocket. For some people, it's better to buy the platinum plan, pay the higher monthly premium, and pay a very low to no deductible at all, so that most of your expenses are paid. And that's part of what we're doing at no charge. We're doing it as a public service to our clients. So be very happy to help your brother.
But Steve, Sandy wanted to know, Steve, what is derived of the deductible? It's adding up all the medical costs.
It's everything.
Doctor visits,
yep.
Yeah, everything.
It's everything, including your prescriptions. It's every bit of out-of-pocket pay, not including the insurance premium. And that's what's going to lead up to your deductible so that you could start getting the co-insurance, so to speak, afterward.
And how about dental? Is that included too?
No, dental is not. No. Dental is not. It's strictly medical coverage.
Medical.
And not eye care either.
Yep.
Wow.
So it might be better to go with the
well, it all depends if you know he's going to need a surgery, or if an illness runs in your family and you think he's going to be sick, then you may want to have the low deductible or no deductible. But if he's healthy and he wants to gamble that he's not going to use insurance a lot because you do get your free checkup annually, and that's all he goes to the doctor for, and then you can go for the high deductible.
And here's what I tell people, too. The one thing that every plan has that it never had before is a max out-of-pocket cost. And that includes your deductible. So what that means is you're only, on every plan, you only are allowed to pay out of pocket, including the deductible, X amount of dollars. And any overage on that, the insurance company has to kick in. So God forbid, if you get diagnosed with cancer or something like that, what happens is, and you go way over that amount, they have to foot the entire bill. So it's to prevent you from having to go bankrupt on your medical bills.
Okay. But I will tell you, the out-of-pocket on a bronze plan is remarkable.
Yeah,
it's
high.
It's really expensive. So, that's part of what you have to look at in your own individual situation. How sick am I? What is my history been
also,
to go to the doctor?
His income is low, so I'm thinking that he may even apply.
How much is his income?
I would say his income is like $40,000.
Well, that's not that low.
So low. Well, I mean, he's supporting.
The whole thing is this is what I'd suggest.
Okay, is he married?
No, his wife's dead.
Okay, and he has children at home?
Adult children.
Oh, okay.
How old?
30, but they're not working. Okay. He's supporting the whole house.
All right. Are they're not working?
No, they're not. No.
So they don't have any source of income?
As far as I know, no.
Okay.
So they're his dependents?
They are. They are.
So I would suggest you give us a jingle on Monday, 632-7886, and we'll help you, okay?
Yeah, I appreciate
Thanks, Sandy. All right, and we're going to go to Chris in Orchard Park. Hey, Chris, how can we help you?
Yes, good afternoon. How you doing?
Good.
Just had a quick question. I was reading Title 26, 6065, and I'm not sure if you're familiar with that code or not, or that section.
Oh, come on, Esther.
What is it?
It's let me see here. Title 26, 6065, verification of returns. And if you don't mind, I can
of returns.
Okay.
Yeah, section 6065, verification of returns.
Okay.
And it's just two sentences. Let me just read it. Except otherwise provided by the Secretary, any return declaration statement or any documents must be verified in written declaration that is made under penalties of perjury. And the only reason why I'm bringing that up is because a lot of times when they send you bills, the IRS, they never sign it under penalties of perjury. And I was always wondering why, because they just do an assessment and they say, oh, you owe us X amount, and it's never signed under the penalties of perjury.
Actually, I've seen notices where it does say under penalty of perjury, and on the return too, it'll say that on the return as well when you right by the signature line there. I've seen that too.
But he's talking about the IRS.
When the IRS says, "Steve, you forgot to claim."
Chris, there is all of penalties that can be assessed if you're filing a frivolous return, and there's a whole segment of people that think that they don't have to file a return, so be careful that you don't get into that quagmire, because the IRS really does have the power to assess tax liabilities. I know we have Norm from Elma holding, but we just don't have time. Norm, we're going to talk to you off the air.
And Mark.
But until next Saturday, I'm Esther Golias, the tax lady, with Steve Jacobson, Christopher Fabian, and Tiffany Fabian. If you need the very best tax help for the most reasonable fees, we hope you'll think about EG Tax, because we certainly want to help you. You can go to egtax.com, and until next Saturday, we hope to see you in our offices. Have a great week. Happy New Year.